The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, everybody, how you doing today? So welcome to the Diagnostic Trading Hour here at TFNN.com. You can also join us at TFNN.mobi. And I just wanted to let everybody know that we are rearing and ready to go. You can call in right now with any questions that you have. We got the Fed funds rate and several other announcements coming out over the next couple days. You can call in at 877-927-6648. Again, that's 877-927-6648. And if you're international, call in at 727-445-1044. And just to take a quick look at the markets right now, looks like we got the S&P up about 5 points. We got the Russell down 3. We got the NASDAQ up 5. Looks like here we got the Dow up 55 points. And oil is moving a bit with a move up, $1.21 so far for the day. And the euro dollar sort of sitting flat, just down a few pips on the day. And you got the pound dollar down 73 pips. And corn and soybeans continue to make a retracement off those highs recently. So, we're keeping an eye on those markets and seeing where we can find opportunities in them. And as I said, we have, of course, the Fed funds rate is coming up soon. And before we go into that, we'll talk about that. We'll talk about some potential trade setups and just different ways that you can play that. But to do a quick recap of this morning, what happened on the news and things that went out, we had the ADP non-farm employment change, and that came in actually ahead of expectations. So a little bit better than expectations, but actually lower than the last report on July 5th. It came in at 163,000. The expectation was 121,000. Last month, it came in at 176. So the downtrend obviously not being the most positive sign, but nevertheless still better than what they thought was going to happen. And the market did react a little bit to that, not near as much as I would have liked to have seen. But basically, everything's stunted. All the announcements stunted right now just because of the Fed funds rate coming out today. And you can go in, we can actually take a look at that and see, what was happening when that announcement came out this morning over on the futures market. And if we zoom in right here, we'll look at the S&P. And the announcement came out this morning at 8:15 Central, 9:15, looks like 8:15 Eastern, 7:15 Central there. And let's go ahead and I'll update everything for you. There we go. And so if we're looking at that and we got the time there, like I said, at 7:15 Central, then we can see the announcement came out and literally right here. And there's a little bit of a drop and then I moved back up and then it sort of trailed back up over the course of the day there. But again, market basically just wasn't real happy with that. Wasn't happy with that number and wasn't real pleased that it dipped below the previous reported number on July 5th. In addition, we had a few other reports come out later at 8 o'clock Central, 9 o'clock Eastern there. We had a report come out right here, and we did actually get a little bit of a spike on that one, and that was the ISM, or the Final Manufacturing PMI. It actually came in worse than expected, but the market still decided to spike up, I guess knock out a few stops before it came on back down. And if you don't know what the Final Manufacturing PMI is, basically it's just a leading indicator of economic health. And businesses obviously like to react to market conditions, and their purchasing managers are a big part of that. And so what they do is they survey 600 different purchasing managers and ask them, various questions about how they feel about the level of conditions of employment, production, new orders that they're looking at placing, prices, deliveries, and even their inventory. And then right after that, we had at 9 o'clock Central, 10 o'clock Eastern. We can go right over here on the chart and see how the S&P responded. And we got the 9 o'clock report right here. And we did actually have a move off that one. It oscillated a little bit and then went ahead and fell back down on that. And on that report, now we had several reports come out at once, so that can, of course, mix up the results. But the most important one that came out was the ISM Manufacturing PMI. And that's where they actually survey 400 purchasing managers, and they ask them to rate things like employment, production, everything else. And it's a little bit more important number. It's released on monthly on the first business day of the month, and it has basically more impact. It came in at 49.8, and really it needs to be moving up. And that was a little bit higher than the last number, but really anything above 50 is going to be considered expansion. So 49.8 comes in just shy of 50, not really showing expansion in the market. And that came in this morning, and market dropped off, seeing that number still was not above 50. And then if we go on down and we look at construction spending came out, construction spending actually was down a little bit at 0.4, expectations around 0.5%. And then we had the ISM manufacturing prices. And again, that's part of that same survey, but it has more to do with the price number. And that came in a little above expectations, but still below 50. That number needs to be at 50. It came in at 39.5, which is better than the last report, but much lower than the previous month's report, where we've been averaging around 61 on previous month's report. The last report was 37. The one before that was 47. So it did make a little bit of an uptick, but still not that big of an uptick. Really little to no impact on that announcement. And that is probably what caused, whenever you have several reports come out at the same time, and you can see that right here on the chart, that's probably what caused the up and down move real quick, because you had some good and some bad. But in the end, the most important number that came out was at 9 a.m. was the ISM manufacturing PMI. And that number, again, really not making a big improvement, and coming in shy of the 50 number, went ahead and caused the S&P to drive on down. After that, we had crude oil inventories come in. And crude oil inventories really came in way below expectations. 6.5 million inventory less. They thought they'd actually be down 1.5 million on their inventory. They're down 6.5 million on the inventory. And that should be basically what's responsible for the spike that we're seeing over in oil today. And if we go in, we can look at the oil and check that out. Pull it up, and we'll zoom in there. Again, that came out at 9:30 Central, 10:30 Eastern. And let me go over here, and we will look at it. So you can see basically right here when this report came out, this is a good time. I love to play the oil and the natural gas inventory reports using the Nadex spreads, because a lot of times they will go in and you can either straddle them, or you can wait till after it comes out, let it do its initial spike. It'll usually do a pullback and then go back in the same direction. That's exactly what happened today. So today right here, 9:30, inventory report was lower than expected, and it's really interesting. It basically influences the price of petroleum, and that affects, of course, inflation, but also impacts growth. And so they're saying basically supply is lower, therefore cost should rise. And so the price spiked up, did its usual pullback, and you can see this if you go back and you look on previous reports. A lot of times you're going to see this come up, where we can actually see the initial move, the pullback, and then the move again. And you'll see it on natural gas on Thursday also. And that comes out at 9:30 Central, 10:30 Eastern as well. So always a fun play to play. It's one that happens every single week, along with unemployment claims. But those are three different reports that have definite focused market impact, and unemployment claims, of course, affecting the major indices and even currencies. And then the crude oil affecting directly crude oil, and natural gas, of course, affecting directly natural gas. So be looking for that natural gas report tomorrow. Looks like the expectation is 22 on the number right there, and we've had 26 on previous ones. So they're actually looking at inventory to shrink, and which is pretty common right now. So basically what that is it's measuring the cubic feet of natural gas held in underground storage during the past week. So not really a significant consistent impact with natural gas on the market or even on the currencies, but definitely on natural gas itself. And again, you can straddle that. Sometimes I go out to do an outright spread. If I can find a great spread with a good risk reward on the box spreads on Nadex, then I'll hop over and trade those. And if you don't have a Nadex account, make sure you hop over to our website here at tfnn.com, and I'll pull this up here so you can see it. And then right here, two things I'm always going over. I'm always going over Nadex, and I'm talking about some of the tools on the Thinkorswim platform as well. But to open your Nadex account, all you got to do is click on Nadex, and you can get an account for free in about 15 seconds. You just click Create Account, and then right below Start, click Open a Demo Account. Fill in the information right there, and all you got to do is put in your username, first name, last name, phone number, and email address. You hit Apply for Demo. Right away, they're going to send you a password, and you'll be able to log in. Okay? And that gives you access to their charts, to their platform, to their data feeds. Everything is right there, and they give you $25,000 of funny money to play with. So that way you can go in and you can start experimenting and playing the trades. I highly suggest that if you're already trading in the futures or forex markets, that you do this and go ahead and keep doing your trades the way that you're doing them. You don't have to change anything, but start looking at trading the spreads in addition to, and just see on the demo account how your trades, compare. So how much do they make versus how much do they lose, different things like that. And the big thing you'll notice is that, of course, the losses can be much less, and also the capital required can be much less. So if you're a new trader, it's a great thing. It's a great way to get into trading futures and Forex because instead of you get the high leverage. I was looking at a trade yesterday, and the leverage was 220 to 1 or 223 to 1, and which was twice that on the futures market. So twice the leverage in my favor, but it could only go against me by $40 on that trade, and $400 on 10 contracts. So. And you can go in and you can do just one. I mean, you can literally place trades that are only $10 or $15, especially on Forex. That's happening all the time, where you can go in and you can place trades at a really, really low risk level. And it's definitely a great way to start trading. It's a great way to keep trading. And, I feel sort of naked if I don't trade without Nadex, because I either trade Nadex just directly using the spreads, or I trade it as a hedging strategy. And so we're going to talk about a way to straddle the market or even hedge if you do want to go ahead and place your hedge on the Nadex platform today on the Fed funds rate announcement. So you should, of course, expect some moves, and when that announcement comes out. Now, what do we expect on that announcement? Well, here's the expectation. The expectation is not for QE3 to be announced. If that was announced, the market would have probably an insane rally. It'd be very interesting to watch, but that is not the expectation. There really just hasn't been enough to justify that yet. And so the expectation is that QE3 actually may be announced. There's become a very high consensus that it may be announced on the September 13th and 14th announcement. And you can pull up, we can pull up Forex Factory, and you can even go over here and you can check out future calendars. And so you can actually see right here, when the actual announcement's going to come out. And we got the FOMC statement scheduled for September 13th, where they're going to be announcing that. So that actually is when the announcement is expected for us to be able to see a possible QE3, come into place. And that's going to come out right before several other important things. We talk about this just about every day right now. That's going to come out before the German Supreme Court is going to announce basically right here on the weekend, and it'll lead into Sunday and Monday trading, of course. But they're going to be announcing whether or not it's constitutional for the German people to bail everybody else out. And so that's going to be a volatile week. That's also coincides with the debt ceiling deadline, the drop dead deadline, where they have to come to an agreement. And right now there is rumors that they're looking to do a 6-month extension instead of a 12-month extension on the debt ceiling, which would basically put it right past the election, past the lame duck session, let the new or whatever president be sworn in, and put everything into place there. And so basically whatever the Congress is going to be, it's going to be. Whatever the White House is going to be, it's going to be. And then they can make that decision and take care of that in mid-March. So that'll be interesting, but all that is happening in the same week, and that's just 5-6 weeks from now. Tomorrow there's a couple things going on as well. We have the ECB rate is going to be coming out. Or not the ECB rate, but the ECB announcement. They're actually starting their meeting. They're going to be having a press conference tomorrow morning. And so let's see if we go over here and I turn the filter off on the news announcements. Then what I can see is it'll pull up some details, and we'll talk about that ECB announcement and also a parliamentary vote that's going to be affecting that. So go ahead and stay right there. We'll talk about that and what to expect for tomorrow and how to play the Fed funds rate today. I'll see you right after the commercial break.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit tfnn.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows. Plus, see all the charts as they happen live during those shows and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour here with Darrell Martin. And we're just reviewing several of the things that are coming up. We were talking about, of course, the Fed funds rates coming up today. We did a recap of the news this morning. And we're talking about the news that is coming out tomorrow. So looking at the news that's coming out tomorrow, we can check this out. And this is Thursday. There's going to be a Spanish unemployment is going to be coming out. And then we'll also have some other things. But one of those big things is the Spanish bond auction. 10-year bond auction is going to be coming out tomorrow morning. And then Pound is going to release its official bank rate. And so we'll see if there's any change on the bank rate there. So that's going to watch on the pound dollar and the impact that could have. Also, the big announcement is going to be the ECB press conference. That's going to be happening the exact same time as unemployment claims. And you want to keep an eye on that. There's also a big parliamentary vote tomorrow to decide whether or not Spain should get the $100 billion bailout in Germany. So that parliamentary vote is going to have, of course, a big impact on Spain, its bonds, and just the whole euro as a whole, the euro as a whole, and trying to figure out what's next. And one of the rumor mills that's swirling around out there is a new option called the bazooka option, and it's basically where they're looking at possibly giving the ECB the ability to have an unlimited bank, sort of like the Federal Reserve, where they can print unlimited money. So that way there's no more number tied to we have to have this much or that much. Because the bottom line is they've already pumped well over $1 trillion in, and they've went through 2 different reforms of institutions that are helping do bailouts. And the fact is, if Spain were to need a bailout, it'd be at least $1 trillion. If Italy were to need a bailout, it'd also be at least $1 trillion. And so the only way they're going to be able to get that going is if they actually have a separate bank that can basically print unlimited money. And they think that a lot of countries, of course, Italy and Spain being, at the head of that, France also is saying this, they think that's the only way to stabilize the euro. Of course, that also would cause massive inflation and have a lot of negative impact on the markets as a whole. Basically, that caused the euro to get stronger, or actually weaker, I guess, cause it to get weaker because it take more euros to buy pretty much everything, causing the dollar to get even stronger. So, depending on how all that goes, but if people think that there's going to be a QE coming up, that can of course have an impact. If they think that Europe is actually going to have, I don't think they'll have any big action items. I think they're going to come out with a lot of promises and a lot of statements, but they really haven't had anything yet, no matter what they've said. Now, people do usually get all excited when they say they're going to do something, but people are getting pretty sick of them saying they're going to do something and not doing it. So we really shouldn't expect anything big to come out of this big announcement tomorrow, but it will nevertheless have an impact on the markets. After that, there's really nothing big. Like I said, we got unemployment in the press conference, and then we're going to have natural gas storage. There's a few more earnings announcements coming out, but the big boys are pretty much done at this point, and mutual funds have basically pumped their money into the market at this point. And they'll be waiting really to see what happens over the next few days. After that, I would not be surprised to see a pullback starting to come back from the funds to reduce their risk, just depending on how the next 2 days goes. If they start looking pretty negative, then I could easily see the fund manager starting to allocate funds more over to bonds and things like that, and out of the actual stocks. Just keep an eye on there's a lot of different ways to measure different stocks and things like that, but you can see just basically where they're putting their money and if they're pulling their money out. If they start pulling their money out of companies that are strong and they're not really moving it into other companies, then that's a big clue for you that they don't really see anything going on. And then Friday we're going to be wrapping up, and we'll have the big announcement, the non-firm employment change and the unemployment rate coming out at the same time. And later we'll have the ISM non-manufacturing PMI. So those are really the announcements of the week, and of course the big announcements coming out on that second week of September we want to keep our eye on. And now what we want to do is we want to be able to start looking over at Nadex and seeing what are some of the trades that you could have done this morning, and what are some of the trades that you can do today with the Fed funds rate coming out, and what are some of the trades that you could be looking at for tomorrow morning with the announcements coming out from the European press conference. And so what I want to do first is just look at, one of the things we're always pointing out that I like to point out to you is, we go over 4 areas in diagnostic trading. That's why it's the Diagnostic Trading Hour. And the Diagnostic Trading Hour is about fundamentals, seasonals, technicals, and statistics. And statistics being standard deviation moves. And we just talked a lot about fundamentals. And every once in a while we touch on seasonals and technicals. And right now what we want to do is, like I said, I always like to make sure you understand the standard deviation levels and see how that's actually impacted the markets. And we can go over and we can look at an area, say, such as oil. And if we check oil out, oil standard deviation move for the day was $1.50. It closed out at 87.96 yesterday, and that means the expectation was for it to go up to 89.46. Well, if we look at the high on the day, what we can see right here is it actually touched up at 89.47, 1 cent off of the standard deviation high. So that right there told you that's where to take your profits on your oil contract. And if you want to fade the market, that would be the place to do it. So anyways, we'll talk more about trade setups, and we'll be right back after this commercial break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of tfnn.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks. This is Darrell Martin here on TFNN.com, and want to go ahead and go over the current market. And we're looking right now at the S&P up just a few points. The Russell is now down 7, and we have the NASDAQ basically flat down a point, with the Dow up 34 points, and oil is up $1.15 coming in off those highs. And natural gas looks like it is continuing to sink down a little bit. And corn and soybeans not moving a whole lot more, but definitely did pull off of their highs quite a bit earlier today. And like I said, when we left last time, we were talking about the standard deviation levels. And on the standard deviation levels, the expected high of the day for oil was 89.46, and we got a high of 89.47. So literally right on that standard deviation level. And just to show you ways that you could have played that so you can understand just how to use these standard deviation levels in your own trading, let's go ahead and pull up the Nadex platform, and we go over it when we can check out oil. And under oil, let's see here. If you hit refresh, by the way, it's the quickest way to shrink everything. And we go to commodities, bull spreads, and we go to oil, and then we go over here to the dailies. You probably want the daily 500-point wide ones right there, or you can do the 8 to 230. They'll be narrower. So you're going to find the ones that are going to be closest to where the market is actually trading at the time that you're looking to place the trade. So, the trade, let's see, right here when the announcement came out was right at 9.25. Now, you could have got in earlier, but let's just look right about that time. 9.25, we had a closing price of 88.63. Okay, so 88.63. So let's see if either one of these gives us a closer price. This one's at 88.50. So that gives us a really good close floor, which is important if you're looking at buying. And the report, again, did come out bullish there. And, again, you can either get in before the announcement, or you can let the announcement come out, let the, good, bad news, lower inventory means higher prices. Higher inventory means lower prices. So higher or lower inventory came in, price spiked up, pulled back. So you could be waiting on that pullback, usually about to the price right around here before you'd be looking to get in. So if we got in somewhere around, we'll just say, 10:05 to 10:10 Central. So, and what we can do is we can actually pull up the chart on Nadex, and we can look at what the prices were trading at. And there'll definitely be some premium in there because that was right around a news announcement. And let's see here. We got going from 8 to 2:30 there. And we can look at basically what was it at. It's right around 89. Now, it was not at 89 that early, so we got to see if we can back up on the chart if it'll give us a little more data. And sometimes they give you the full data, sometimes they don't give you the full data, depending upon if you had your platform open at that time, and just how the charts work, basically. So I'm trying to see if we can get a good quote price on this. And it looks like you're going to get a price right around 89. That would have been a bit of a stretch, but you still could have done it. You could have pulled in about, looks like 50 ticks on that, and but basically a 1-to-1 risk reward on that trade, risking 50, making 50 on the trade. So not a great trade, not a horrible trade, but just a trade that I would have been more cautious on just because I don't like the premium on that trade. Now you also could have got in earlier, and we can look at what those earlier trades would have been like. So if we go in and we're checking out the 8 to 230 and looking at the 88.50 ones here, we'll pull that up and see what we get. See if we get maybe a little better price quote, closer to what we're looking for. And let's see here, pull these, and we'll look at this one as well, just so we can get a full spectrum of the different spreads that were available. And on those spreads, let's see, yeah, we had one down here, about the lowest it got was, let's see. You probably wouldn't have been able to, that early in the morning there. So let's say you're getting in, around the market open, around 7 to 8:30 here. You gotta get in around 80, 88.60. So you probably would have been better off, yeah, with the original one. But 88.60 would have been at least about a dollar move that you could have taken advantage of on that trade, and it moved up to 89.40 for you. So 88.60 at a 88 strike level would have given you a $60 risk per spread. And that'd be, that's really nothing. So, on an oil contract, one tick is $10, okay? So $60 risk would be like if you did a full oil contract and you were taking on, not really that big of a move, but if you're basically for every tick, $10, $600, so 60 ticks or $6, risk on there. So that might be a bigger move than you might be wanting to take, but it really doesn't take that much for oil to move a whole lot. And you want to be able to have something, in your arsenal that's going to give you protection, give you a hedge, and help you put it all together. And to me, the easiest way to do that is really with the spreads. And now let's say you want to flip around, and you're wanting to go in, and you're wanting to short up here because we're right here at this standard deviation high level. And so you're looking something as close to really 89.50 as you can get. So to do that, again, always make sure you refresh your list so you're seeing the most current spreads. Go over, pull up crude oil, and then just start going down the list. Now, understand the times on here are Eastern time. So this is going to be 2 Eastern, 1 Central. And so even though you may be able to find a spread that's great, if it expires in 15 minutes, really might not be the trade that you want to do. And that one's a little bit tight, so we may go over and we can look at the next one. That one's going to give us an 88.50 level. So still lower than we want, 91.50. That's higher than we want, $90. That's close. That's pretty close to what you could potentially look at for the trade there. And so on that trade right now, you'd have a $77 risk with a $223 profit potential if the market closes below 89.23. And we don't really have a whole lot of premium built in either. We're basically right at the market. We're straddling them 89.23 to 89.28 with the market quoting at 89.27 right now. So really, we're straddling the market and not an incredible amount of risk on this trade. So we're going to go ahead and I'm going to go ahead and do 10 contracts on this. That's going to give us a $770 risk, which would, again, be a very small move on an oil contract. We're going to take a $770 risk. That means a risk up to 90. It's like having a stop loss at $90, okay? And we're going to place that order. And let's see here. We'll put that in, and we'll see how that trade plays out. So basically, again, just playing the standard deviation level on that trade. And if you have any questions, make sure to give us a call at 877-927-6648. You can also call in internationally at 727-445-1044. If these spreads are new to you, you're trying to figure them out, if there's anything I'm going over that you just have a question on, definitely feel free to give me a call. I'd love to answer your questions. And so we got our position on there on oil. So we're shorting right now. And again, you don't have to take the entire risk in the trade. You can get out early, but the biggest benefit, the number one benefit on the spreads is if we go in and let's see here. I'm sure there's a option on here to do this. We can go in and you put a rectangle on, and so if you have a ceiling, let's just say at 89.50 right now to make it easy on the charts here, and you have a floor down to 87, and I'll pull up the exact spread. We'll actually chart it on here. There we go, and then we can of course edit this if we want to. Let's see here. We'll edit the rectangle. And we can say, okay, put it up at a high of 90 and put it down as a low of 87. And then I want it to end at expiration, so that's going to be 1:30 Central, 2:30 Eastern. Okay? So I could start it now, I guess. So we could go ahead and put 12, 40 or whatever on there, so Central Time. And then we can go ahead and expire it over here again at 1:30. That allows us to draw the chart, to draw the spread on the chart, which is really helpful when you're trading. And you can go in and you can check out exactly, how your chart's going to look, what it's going to look like. And what this means is, if we go in on this trade right here, and this thing is probably a little hard for you to see, so we may even go in and try to make it a little bit more transparent, see if it'll give us that option. It's not giving us an option on this platform, but you can go in and it'll basically, no matter how high oil goes, we can't lose more than our maximum risk. Oil drops down, then we have potential to make quite a bit of profit. And on this trade, the potential for profit is pretty high. Let's see here. We got in at their 89.27 there. And so we look at our potential profit on the trade on 10 contracts is a $2,200 profit on a $700 risk. So, over a 4-to-1 risk reward. And if oil expires where we sold it at, then you know what happens? We just get our money back on that trade. Okay, of course you have your exchange fees that come out. But it's not like a binary trade where it has to, hit something or it's a win or a loss. And, binaries have there's a great purpose for binaries and use them the right way. But a spread is a lot, just like trading oil, okay? So you can use it to basically mimic the underlying, but define your risk and put up less money. To trade a full oil futures contract, you're going to be putting up $1,000 to place the trade. So this actually allows you to put up less money to place that trade. And so looking at that right there, now we can go over and check out some other potential trade setups that we have and some things that you could have done this morning. So with the S&P, bouncing around on the news announcements, so, what were our standard deviation levels? And always keep an eye on those standard deviation levels, okay? So these are important. You may want to note these down for even the Fed funds rate coming out today. On the S&P, it looks like we have a 12.5-point standard deviation level. And what that means is from the close yesterday, 1372, that put us up around 1384.5 as a high on the S&P and down to about 1360.5. Can it go further? Yes. But the standard deviation level lets you know at what point you should expect it to go. How far should you expect it to move? Okay? So those are really going to be your profit goals, you could say, on your trades. And those also might be the points where the market hits and bounces right off those levels. Especially when Fed funds rate comes out, it can sometimes be nuts. It can just fly up and down, up and down, up and down. And so it's a very volatile time. And like I said, there's different ways to trade it. And then maybe you want to trade the Russell. So if we want to look over at the Russell and we pull that up, then the standard deviation levels on it that I have right now, I went ahead and pulled these up before the show so we'd have them ready. And on the standard deviation levels on the Russell, looks like it's $9.77 move is the expected move on the Russell today. So at a 783.3 close of yesterday, that puts us up at a 793.07 and down at 773.53. And if it does break that standard deviation level, you're going to want to look at about 50% of that amount. So about a $455 move if it does break it on the downside. But definitely be ready for that. And, you want to, the reason I say look at a couple different indexes is you want to be able to see which indexes are trading closest to their floor or ceiling. So, S&P, Russell, whatever, they're both going to move when the thing comes out. Okay? So which one can give you less risk? And, if the Russell happens to be trading closer to a floor or ceiling, that's probably going to be the trade setup you're going to look at. If the S&P is trading closer, then that's the trade setup that you're going to want to look at. So right now, let's go ahead and just check them out and see what the potential setups are. And if we're looking over at the Russell, we got 779 is about what we're quoting right now. So let's go ahead and check that out on what trades are available. So what we're going to do is we're going to go to indices, bull spreads. We're going to go to the Russell 2000. And you want to make sure that it's going to straddle, go over the time. So the 2 o'clock expiration, not going to be good for you, because when does the announcement come out? It comes out at 2:15. So you do not want to choose a trade for a news trade that's going to expire before the news comes out, right? So just be careful on that. That's a 1:15, central there, 2:15. So we're going to go over and we'll look at these. So this one really not in our arsenal. We're not going to be checking that one out. And then this one right here is one that we're going to be looking at. It looks like we have a caller, and I'll go ahead and take the call right now. And before we wrap up the show, we will put in a couple things to show you some trades that we can do on the Fed funds rate when it comes out here about 15 minutes after the show's over. All right, Paul from New York, you there?
Hi, Darrell. Just want to ask in terms of studying the moves on a backdating basis. Is that upon opening account? Is it possible to go back, say, 2 or 3 weeks, or a full 30-day cycle to study the moves of oil and the S&P on a backdated basis before actually making trades?
Oh, you're talking about for the standard deviation move?
Correct.
Yeah, that is possible. You'll have to actually have the. Let's see here. What you're going to need is you actually need the formula. So if you want to email me, I can get that to you. Okay.
Okay. Your email address is on your website, on the Tiger website?
Yeah, it's dmartin@tfnn.com. And what you'll have to do, let me show you, because basically the piece that you need that's a little more challenging, we'll say, is you need to go over to the trades, okay? And you'll want to go to, if you're using Thinkorswim, which is just a great tool, you can get access to most of the stuff in here for free, just if you open an account, even before funding it. But, obviously, I think it's a great company to trade with for your options. And
yeah, I do have an account with them. Is that the charts that you're using currently?
Yeah, that's the chart that I have up on the screen right now. And you can go back and you can do analyze, and you're probably going to want to look at the think back feature. And you'll go in and you'll want to pull up oil, okay? And then you'll go in and you want to look at the option chain. And on the option chain, what you're going to need on here is you're going to need the implied volatility, okay? So you're going to have to see if they'll provide that data for you. And because you need the implied volatility to be able to even do the formula, okay? And that's actually what they're using in it. That's one reason you'll notice you go over here to analyze and you try to look at a risk profile, and we try to do a standard deviation. Like if we do it on 6E, the futures market, then we'll see that, and you always got to look at like the next day there. Then you'll see that standard deviation. But if we go over to euro dollar, since they don't have the euro dollar options built in, and we build it in, I was looking at this earlier today, and we can pull it up, and again pull up tomorrow there. You'll notice that nothing comes up because they're not factoring in implied volatility. So you just want to make sure you have the historical implied volatility. And if you can't find it in the think back area, another cool feature in Thinkorswim that can help you out. Let's see here. Maximize this, and you have to look at it on a daily chart, okay? And you go in, and one of the indicators that they have is, let's see here. We're going to add a study, and we want to add implied volatility. It's actually a study where they chart it for you. Let's see if they have it plotting. They don't really have it plotting that helpful. So, yeah, there we go. We can go in there and see it. So there's the implied volatility right there. And so you want to pull the implied volatility for that day, like right at the beginning of the day, to factor in your standard deviation formula. That's how you can go back and back test it. But you also can forward test it. Just pull it up every day over the next couple weeks, and you'll be able to see how accurate it is on a day-to-day basis. Right, if you want to stay right there, I can answer some more questions for you after the break.
Sure.
All right, sounds good.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Catch Tom O'Brien and Steve Rhodes as they teach you the art of mastering money when it comes to trading and investing. The Money Masters, next on TFNN.
Darrell Martin with the Diagnostic Trading Hour, and welcome back. So do you have any more questions, Paul, or the standard deviation that can help you out with on that?
To go forward, what do you find is your most successful strategies, like in a dull market like now, and as opposed to fast-moving markets? Do you go conventional options in futures and then hedge yourself with binaries and spreads? I mean, do you have could you maybe put up a video in the upcoming in terms of the most profitable strategies in the different market conditions?
Yeah, we're actually going to be putting up a whole bunch of videos here in the next 2 weeks. So it'll be coming up, and we'll have a whole diagnostic section on the TFNN site. When the market's flat, now, of course, that's always depending upon what time of day it is. But like right now, like on the, the index, basically it's flat. I mean, we had a little up and down move. And I like to actually go in and sell the binaries, like where I'm collecting the premium. And I'll do that up to the point of the news announcements. And then on the news announcements, or if I'm just, a trending market, then the biggest thing I do, the hedging strategy is my favorite strategy by far over everything, because it has no cap on profit potential. It has the least risk. And, it just it's an incredible trade. You go in and literally sometimes on a full gold contract, I'm risking $50 trading a full size gold contract, and after a couple point move, I'm in pure profit. And so that's really my favorite strategy.
Could you go through that quickly in terms of how do you place that position?
The hedge strategy, that's a pretty big conversation. We can definitely go over it more if you call in tomorrow. I'll give you a summary of it, though, a quick summary. And if you want to call in, I can go through as much detail as you want to. What you're going to do is, if you're going to buy an underlying market like gold or oil or whatever, then you can hedge it by buying the spreads, not the binaries, but the spreads in the opposite direction. So if I'm going to buy oil, then I'm going to sell 10 spread. If I'm going to buy a mini oil, I'll sell 5 spreads because I have to equal the point-for-point move on the ticks.
Right.
And what I want to do is I want to try to get one that's as close to the ceiling or floor as possible. So, if, oil right now is trading at, 89.10, I'm going to want to try to get one as close as I can. Maybe there's one at 89.25, 89.30. And I want to find one that's really close. So that way, as soon as it gets past that point, then the spread stops losing and oil starts making money. And my only risk on the strategy is the difference between where I sell the spread and buy the underlying market or where I sell the underlying market and buy the spread. So it gives me a really, really small risk, which basically is the time premium risk, which sometimes, like I said, is $50 on 10 contracts. So, it can be really nuts. But, yeah, that's my favorite strategy by far.
Okay, now, and also, let me go to a different section. Do you have binaries and spreads on particular underlines like Apple or Priceline, or do you anticipate offering those in the future?
Nadex currently offers on the major indices, international indices, the major commodities, and the Forex markets. They don't have binaries on like stocks and things like that. There's nowhere you can trade those on an exchange. They are available over the counter. So you got your risk with that, international accounts and over the counter. But right now, I don't think that's on the board as of this moment because they're really focused on the futures and Forex industry because they're actually registered with the CFTC.
Okay, because just seen some information on videos. I didn't know if it was true or not that they're offering binaries and spreads on particular underlines, and I didn't know if that was true or not.
Yeah, that is true. There are companies out there doing it, not an exchange. There's over the counter guys, which are they're on the opposite side of the trade doing it, but there's no exchanges that are offering it. Real quick, let me wrap up. We got this Fed funds rate. I just want to let people know what they could do, and if you'll follow up with me tomorrow, we'll go into detail on the hedge strategy. Does that sound good?
Thank you so much, Darrell. Have a good day.
Hey, thanks for your time.
Thanks.
All right, thanks for calling in. And send me that email there. All right, quick summary. I know we're about to wrap the show up, and just want to make sure that you can see everything here. Make sure you go in and look at straddles on either the Russell or the US 500 for the Fed funds rate that's coming out in 15 minutes. Hit refresh on your screen in 2 minutes, and you'll get a whole new set of spreads coming out, so you can find a straddle that's right at where the market is located, okay? So check that out. Straddles right on the US 500 and Russell 2000. Hit refresh in 2 minutes on your Nadex platform to see the most current spreads.